Hi, my name is Christian Waldegrave, Manager of Research at Teekay, and this is our conventional tanker market update for September 2014. Well, looking back at the third quarter as a whole, it's been a particularly strong quarter for the tanker market. In fact, it's shaping up to be the best third quarter we've seen since 2008. And normally the third quarter of the year is a low point of the season for conventional tankers. It's usually a period of lower rates. But this year's been a little bit different, and we've seen particularly strong rates through July and August. And I think that's due to two main factors. Firstly, what we saw in July was a lot of geopolitical disruption in places like Iraq, Syria, Russia, and there was the threat of some physical disruption to oil supply. And what that meant was that a lot of people went out and bought oil and imported oil in anticipation of supply disruptions. Now those supply disruptions didn't materialize. We haven't seen a decrease in production from those regions, but just that threat of those oil outages being there has been enough to cause some extra stockpiling and buying of oil. Secondly, what we've seen in the last few months is that there's a glut of oil developing in the Atlantic basin. And that's largely due to the US domestic production increasing, which means the US is not importing as much oil, as well as European demand being down. And that means that all the oil being produced in the Atlantic, whether it's West Africa or North Sea, Mediterranean, Latin America, there's an increasing surplus in the Atlantic. And that's forcing that oil to move to Asia. So we've seen an increase in Atlantic to Asia oil movements, and that's long haul in nature, so it soaks up a lot of ton miles. And that's been particularly evident in the Suezmax sector. We've seen a large increase in Suezmaxes loading in the Atlantic and then moving to the Pacific. And oftentimes those ships are then staying in the Pacific and going back and loading in the Middle East and staying east of Suez. And that means that there's actually a smaller supply of Suezmaxes in the Atlantic basin, which means that when demand does pick up, it causes the spike in rates like we saw in July and August. What's also happened in oil pricing is that because there's a surplus of oil, it's actually caused a Contango price structure. Contango means that in the futures market, the spot price of oil is lower than the future price. And that means that that's also encouraged some stockpiling and buying of oil by refiners and traders in anticipation of higher prices in the future. In fact, if you remember back to the market in 2010, the Contango got steep enough then that meant a lot of ships were used as floating storage. Now the Contango this time around isn't quite steep enough for that floating storage play, but it does mean that there's been some extra buying of oil going on, and that's really supported oil tanker rates. Moving into September, we have seen that the rates have come off a bit. So from a high of $25,000, $30,000 per day in July, rates came down to about $20,000, $25,000 in August. In September, they're back down to what we would normally expect this time of year, which is around $10,000 to $15,000 per day. And we expect that to continue for the next couple of months because the refinery maintenance season, which is just starting now, really goes through the rest of September and October and into early November. However, when those refineries come out of maintenance in November, and as we start to see some worse weather and some of those winter weather delays, we do expect that the market will come back up again and that we'll have a strong winter, particularly if we continue to see a lot of oil moving from the Atlantic to the Pacific as we have in previous months. The one factor that might be worth looking out for the end of the year is that because there is an oversupply of oil, that is having a downwards impact on oil pricing. And if oil prices do fall a bit more, we might see OPEC, a reaction from OPEC in that they might look to reduce production in order to support prices. And of course, lower OPEC production would mean less oil on the water, and in particular, less long-haul barrels, which could potentially be negative. So that's something to keep an eye on in the coming weeks and months. So that's our outlook for the conventional tanker market, and we'll speak to you again next month.